The silver market continues to capture attention around the globe as prices swing following recent institutional activity and structural adjustments. Today's movements on Comex, influenced by margin hikes, have led to sharp but expected volatility. To understand what is truly happening, it is essential to separate mechanical market responses from long-term fundamentals. Before we begin, if you want calm, fact-based insights into silver, banking strategies, and market trends, subscribe to the Monetary Silver Brief. Each report focuses on market signals, structural analysis, and verified context, not speculation or hype. A margin hike on futures contracts does not inherently change the intrinsic value of silver. Instead, it alters the cost of maintaining positions, particularly for leveraged participants. Traders who rely on borrowed capital must now commit more collateral to hold the same exposure. This requirement often forces rapid position adjustments, creating price swings that may appear dramatic to outside observers. Historically, exchanges implement margin changes during periods of elevated volatility to maintain stability and prevent systemic risk. While these adjustments can temporarily amplify short-term market movement, they are structural rather than sentiment-driven. In silver's case, recent rallies had already attracted speculative interest, making the effect of margin hikes more pronounced. Major financial institutions responded as expected. Several banks reduced short-term silver activity, paused certain strategies, or rebalanced exposure to comply with internal risk models. This is not an indication of diminished confidence, but a procedural recalibration. Banks operate under strict regulatory oversight and capital allocation rules. When market conditions shift, they adjust positions accordingly, often quietly and systematically. Another factor to consider is the distinction between paper silver and physical silver. Comex primarily represents paper contracts. Movements in these contracts, influenced by margin requirements, are immediate, whereas physical markets, driven by industrial demand and long-term holdings, adjust more slowly. As a result, price swings in futures markets often overstate immediate real-world effects. Liquidity also plays a significant role. When leveraged participants step back, order books thin, which can exaggerate price movements. Volatility, therefore, may be heightened even when long-term supply and demand fundamentals remain unchanged. Observers often misinterpret this as panic, but it is a structural response to leverage constraints. Timing is critical. Margin adjustments often occur when markets are stretched or approaching inflection points. These moments are natural pauses, allowing participants to recalibrate and markets to stabilize. In this sense, today's volatility is less about silver losing value and more about the market finding a new equilibrium under updated conditions. Silver's dual role, as an industrial metal and a monetary-sensitive asset, adds complexity. While speculative activity reacts immediately to mechanical changes like margin hikes, industrial users maintain steady demand. Electronics, energy, and other sectors continue to require silver, ensuring that underlying consumption remains intact despite paper market fluctuations. The first lesson from today's movement is clarity. Immediate price swings reflect leverage and structural adjustments more than long-term sentiment. Understanding this distinction allows investors, analysts, and observers to interpret market behavior without overreacting to short-term volatility. Today's silver market reflects procedural recalibration and temporary liquidity constraints rather than a fundamental rejection of the metal. Price movements are amplified by leverage, margin adjustments, and institutional repositioning, but the underlying drivers remain robust and continue to evolve in line with industrial demand and macroeconomic factors. Understanding institutional behavior is key to interpreting silver market volatility. Unlike retail traders, banks and major financial institutions do not trade silver solely for short-term gains. Their engagement is structured around capital efficiency, risk management, and regulatory compliance. When margins rise, as we've seen on Comex recently, banks must reassess the economics of holding leveraged positions. A margin hike increases the cost of participation, which directly impacts return expectations for short-term strategies. Trades that were previously profitable under existing capital requirements may no longer meet internal thresholds. Consequently, banks may reduce exposure, pause specific trading activities, or adjust positions across related instruments. These adjustments are procedural, not speculative judgments about silver's value. Risk management protocols play a central role. Banks operate under strict internal limits and regulatory scrutiny. When volatility increases, risk committees evaluate positions to ensure that balance sheets remain secure. Sudden changes in margin requirements can trigger immediate reviews, which often result in temporary reduction of activity. Observers may interpret this as hesitation, but it is a methodical recalibration of risk, not a loss of confidence. Banks also distinguish between trading silver and monitoring silver. Even during periods of low activity, research teams continue tracking industrial demand, macroeconomic trends, and monetary indicators. Physical and industrial consumption, especially in electronics and energy sectors, continues steadily, providing long-term structural support. Timing and strategy matter. Margin hikes often occur when markets are stretched or near technical inflection points. Banks recognize these moments as opportunities to pause, reassess, and reposition. Some adjustments may move activity off visible exchanges into over-the-counter markets, options, or longer-dated contracts. To outside observers, this can appear as inactivity, but internally it is a strategic realignment. Historical context provides perspective. Previous cycles show that banks temporarily reduce exposure following margin increases, only to return once positions stabilize. This pattern is consistent and highlights the importance of observing structural behavior rather than reacting to price swings. It's also crucial to understand that institutions benefit from market stability rather than directional moves. Extreme volatility increases operational risk, funding costs, and hedging complexity. By stepping back temporarily, banks allow markets to adjust and stabilize, reducing risk across their portfolios. Another key point is liquidity. Reduced institutional participation may thin the market temporarily, amplifying short-term price swings. This can create misleading narratives, making it appear as though banks have abandoned silver. In reality, these movements reflect structural adjustments to risk and capital allocation, not a fundamental rejection of the metal. Silver's dual identity adds complexity. While paper markets react immediately to margin changes and liquidity constraints, physical demand remains guided by industrial requirements. Investors should recognize this distinction to avoid overinterpreting short-term price volatility as a signal of market failure. In conclusion, institutional responses to margin hikes are systematic, strategic, and structured. Understanding this behavior helps separate mechanical market reactions from fundamental changes in demand or value. Observing how banks adjust positions offers insight into market structure, risk management, and potential trends, not speculation about imminent collapse or runaway rallies. After the initial adjustments from margin hikes and institutional repositioning, the silver market enters a transitional phase. Understanding this phase is critical because price movements during this period are driven more by structural realignment than by shifts in underlying fundamentals. One of the first effects of higher margins is a reduction in leveraged positions. Traders who relied heavily on borrowed capital are forced to either reduce their size or close positions entirely. While this creates short-term volatility, it removes speculative excess, allowing prices to better reflect longer-term demand and supply conditions. Liquidity is also temporarily affected. As participation thins, order books can become less deep, and price swings may appear exaggerated. This does not indicate a loss of confidence in silver. Rather, it is a mechanical response to changing market conditions. Once markets absorb these adjustments, liquidity tends to return in a more balanced form, setting the stage for smoother price discovery. Margin hikes also serve to reset market expectations. When rallies accelerate too quickly, expectations can become detached from structural realities. By imposing higher collateral requirements, exchanges encourage participants to reassess positions. This leads to a temporary pause in momentum and a more deliberate process of price formation. It is important to differentiate between paper and physical silver. Futures contracts, which dominate Comex, react immediately to margin changes because they are highly leveraged. Physical demand, driven by industrial consumption in electronics, solar panels, medical devices, and other sectors, continues largely unaffected. Understanding this distinction prevents misinterpretation of short-term volatility as a fundamental crisis. Silver's dual role, as both an industrial and monetary-sensitive asset, adds further complexity. Monetary factors, such as interest rate expectations and currency movements, influence investor sentiment. Industrial demand remains grounded in real-world usage. Margin-driven market moves primarily impact paper trading, not the physical flow of silver. Another signal to observe is reporting. Once initial forced adjustments subside, futures positioning, delivery statistics, and inventory updates provide more accurate insights into institutional behavior. These data points reflect deliberate decisions rather than immediate reactions to margin changes. Volatility in this transitional period is natural. The market is absorbing structural changes while participants evaluate risk and strategy. Sharp swings during this period are not inherently indicative of market failure. They often reflect necessary recalibration. Time horizon matters as well. Structural adjustments do not resolve overnight. Patterns in trading volume, positioning, and price ranges over weeks can reveal whether the market has reached a new equilibrium. Historical cycles show that silver often consolidates following margin-driven moves before resuming directional trends. Finally, interpreting narratives is key. Early reactions to volatility tend to exaggerate outcomes. Over time, as market mechanics settle, the true state of participation and demand becomes clearer. Careful observation of these factors allows investors and analysts to understand the market's structural health rather than reacting emotionally to headlines. The transitional phase post-margin hike is characterized by reduced leverage, temporary liquidity shifts, and a reset in market expectations. Observing participation, volume, and physical demand provides clarity on silver's behavior, distinguishing structural adjustment from fundamental change. After the initial shocks from margin hikes and institutional repositioning, the silver market is entering a period where observation is more important than reaction. This phase is quieter, but highly informative. Instead of dramatic headline-driven swings, the market begins to communicate structural adjustments, shifts in participation, and emerging trends. For anyone tracking silver, focusing on these signals can provide clarity and perspective. One of the most important indicators is trading volume. Following margin hikes, volume often declines sharply as leveraged traders step back. However, the pattern of returning volume over days or weeks is far more telling than the initial drop. Gradual, steady volume resumption often signals adaptation and stabilization, whereas persistent thin liquidity can indicate ongoing caution among key participants. Another key metric is price behavior during low news periods. When markets are calm, the way silver trades can reveal underlying strength or weakness. If price remains within stable ranges despite macro fluctuations, it suggests balance. Conversely, erratic movements during calm sessions may indicate unresolved tension between leveraged positions and structural supply-demand factors. Institutional positioning should also be closely monitored. While banks may temporarily reduce visible trading after margin changes, their activity often shifts into less transparent channels, such as over-the-counter trades, option strategies, or longer-term futures contracts. Tracking positioning reports, open interest, and inventory data helps reveal whether institutions are rebuilding positions, hedging exposure, or simply observing. Physical silver flows are equally significant. Industrial demand from electronics, energy technologies, medical devices, and other sectors remains a steady driver of consumption. Unlike paper markets, these flows respond slowly to margin hikes and short-term volatility, offering a stabilizing effect on overall silver demand. Observers should differentiate between temporary paper market swings and long-term physical market behavior. Macro factors also continue to influence silver. Currency fluctuations, interest rate expectations, and broader monetary policy shape investor sentiment. For example, rising interest rates may encourage shifts into other assets, while weaker currencies can increase silver's appeal as a store of value. Margin adjustments interact with these macro conditions, creating a complex but interpretable environment for price behavior. Volatility trends provide further insight. After the initial reaction, a decline in volatility often signals that the market has absorbed the structural change. If volatility remains elevated, it may suggest unresolved risks or ongoing uncertainty among major participants. Observers should track intraday ranges, daily swings, and the frequency of large trades as proxies for confidence and market balance. Another critical point is market narrative evolution. Immediately after a margin hike, dramatic headlines dominate commentary. Over time, as liquidity stabilizes and participation resumes, these narratives adjust to reflect structural realities. Analysts who focus on data rather than headlines often gain a clearer understanding of how silver is adapting to new conditions. Patience is essential. Structural shifts in markets unfold over weeks and months, not days. Short-term reactions are rarely indicative of long-term trends. Historical patterns show that silver consolidates after major adjustments, allowing participants to reposition before establishing new directional momentum. Understanding this cycle helps prevent overreaction to initial volatility. Observers should also consider the interaction between leveraged and non-leveraged participants. Retail and speculative traders react to headline-driven volatility, while institutions, industrial users, and physical holders often operate independently of short-term swings. Monitoring the balance between these groups can provide insight into potential price stability and the market's capacity to absorb shocks. Finally, it is important to view silver in context of broader financial markets. Margin hikes are just one factor among many. Global liquidity conditions, banking regulations, geopolitical developments, and investor sentiment all interact to influence both paper and physical silver. Awareness of these broader dynamics helps prevent misinterpretation of short-term market behavior. In conclusion, the post-margin adjustment period is characterized by gradual stabilization, structural recalibration, and evolving participation. Watching volume trends, institutional positioning, price behavior, physical flows, and macro alignment allows observers to understand the market without relying on speculation. Silver continues to play its dual role as an industrial metal and a monetary-sensitive asset. While short-term paper market moves may appear dramatic, underlying fundamentals and industrial demand provide a stabilizing framework. By focusing on these signals rather than headlines, investors, analysts, and enthusiasts can interpret market behavior with clarity. This phase demonstrates that volatility is often structural, not fundamental, and that patience, observation, and understanding of institutional behavior are critical for navigating complex markets. Silver may continue to surprise in the short term, but careful observation reveals consistent patterns that indicate how the market is truly functioning.